Credit score hacks. Here's some ways to boost your credit score for a better mortgage rate going forward. Hey, what's going on, everybody? It's Jeff Trevarthen, Jeff the Mortgage Pro. Thanks so much for watching. Huge favor for me. If you like these videos, go ahead and click that like button down below. And if you really like these videos and you want to see more of them and you want to see when they come out, go ahead and hit that subscribe button along with the bell next to it. And that way you'll be notified when these videos come out. I love to have you subscribe to my channel. I try to put these out a couple times a week at least. And just trying to get my message out. I want to be the #1 lender on YouTube at some point here. And all of your support really means a lot to me. So let's look at a couple things today about how to improve your credit and what things we can do. How can we hack your credit to be able to get you to the score that we need you to do? So first off, let me tell you the different ranges of credit score. They're called credit score tiers. So for the most part, it starts anything below 620 is the bottom of the credit score tiers. So if you have a 580 credit score, you're going to fall in this lowest tier. The next tier up is 620 to 639, and then the next tier up is 640 to 659, and then 660 to 679, 680 to 699, 700 to 719, 720 to 739, and then anything above 740. Those are the different typical credit score tiers. The better the credit, the more optimal interest rate you're going to get. If you have above a 740 credit score, that's probably going to give you the most optimal credit. And as recently as 2023, they're actually throwing another credit tier in there all the way up to 740 to 760, and then even 760 to 780. So just kind of keep those in mind. So if you have above a 780 credit score, in reality, you're doing pretty darn good, and you're probably going to get the most optimal financing possible. If you're on the low end of that, it's going to definitely affect your monthly interest rate that you pay on your mortgage. And guess what? That's going to add to additional cost over time. So is it worth it to help you get your credit score up? Absolutely it is. All right, let's look at two things that a mortgage algorithm looks at. They look at two things mainly, and this is how mortgage credit reports are weighted differently than probably any other types of credit reports. Like if you're going to get a car loan, it's going to be different than this. But mortgage credit reports look at two things. They look at your payment history, your on-time payments. Okay, how late a payment definitely can affect a credit score in a certain way. And what's going to happen is it's going to be a really sharp drop initially. So if you had a late payment a month ago, your credit is going to have the biggest hit the following month. That's going to drop like 80 or 90, maybe even 100 points from where it was. So if you had a 740 credit score going in and you had a late payment, it's going to drop it like to 640. It's going to be terrible. But over time, as you continue to make more and more on-time payments, it's going to get that credit score back up over time. And it takes a long time for it to get back up. So missing payments is a big deal in the mortgage world. We don't want you to miss payments on this. It just shows your credit worthiness on how you repay your debt. So make sure that if you do have a late payment, start making that payment back. You do the best thing you can. It would be to call whoever you had a late payment and see if you can get that removed from your credit report. And if you can, that's awesome. And if not, we're going to have to try to keep building your credit report back over time. So #1, on-time payment history. And then the second thing that mortgage algorithms really weigh when we're running credit scores is your proportion of credit balances to the credit limits. And what I mean by that is that the best way to do this is to pay off your monthly revolving debt every single month. So if you have a $1,000 balance on a credit card, try to pay that off every single month if you can. That'll be the best and most effective way to get your credit score maximized when you're doing that. If you can't pay it off every month, try to keep your balance under 30%. That'll lower your credit score by just a little bit, but if it's under 30% and you're continuously paying it down under 30%, that's going to be better than getting it over 30%. And then lastly, like the last little tidbit that you could try to do is to keep it under 50%. So it'll be a little bit lower, but it's not going to be as bad as it would be if it was over 50% credit utilization. So what I mean by this, let's say you have a $10,000 credit card limit that you have, and every month you charge $1,000 on it, but then every month you pay it off. That would be the ideal scenario. Let's say you can't pay it off every month. and you run it up all the way to $3,000. Try to keep the monthly payment under, or not the monthly payment, but try to keep the whole balance under $3,000 if you have a $10,000 limit, and that way your credit will still be optimized. And then lastly, if you just can't keep it under 30%, try to keep it at least under 50%, and that'll still give you at least some benefit for the credit. It won't be perfect, but once it starts to go over 50%, it's going to have a negative impact on your credit score. Okay, so payment history and proportion of credit balances and credit limits definitely need to make sure that those things are lined up as long as you can continue to do that. Okay, there's a couple tools that you can do to hack some of this stuff when you're doing a mortgage loan. The first one is called a what if simulator. And what this does is it shows you what you need to do in order to get your scores to a certain point. So if you need to move $78 from one credit card over to another credit card via balance transfer, that could increase your score by 12 points, for example. That what if scenario calculator will help you do that. It's not a tool that you have access to, but it's a tool that a lot of mortgage people like myself have access to when we do your credit score. So that's one way we can hack your credit, is to use that what if simulator by just moving money around. And the other thing is to determine, it's called the how much money do you have to spend? And what this type of a calculator does that we have access to in our credit reporting systems is it shows you what debts to move around and what debts to pay off within your budget, depending on how much money you have available to do that. So if you have $5,000 to pay down a car loan or pay off a credit card or move a student loan payment down a little bit, which one of those things would benefit you the most in terms of your credit to be able to get it optimized enough? So a what if simulator and then a dollar figure simulator, then those are the two credit things that we can do to hack your credit to help you get to a higher score. Okay. If you guys have any questions about credit and you want to learn how to get a mortgage and optimize that credit so you don't have to pay, obnoxious interest rates over the life of your loan and extra money over the life of your loan, because credit is really important when you're borrowing money, make sure you reach out to me. I'm going to put my calendar link down below, and I'd love to have a conversation with you about what to do and how we can help hack your credit to make that payment for you optimize as much as we possibly can. Thanks a lot for watching. I look forward to chat with you guys on the next one. Have a good day, guys. Bye.